What is good, guys, and welcome back to the channel. And today we will talk about this price action here, where I was tweeting that I'm pretty sure most of you got chopped up trying to short euro inside this range here. And why do I know that? Because if I look at this price action and I remember my younger self when I got into trading, I used to get chopped up as well trading those conditions. And I want to today show you guys how you can navigate those conditions and avoid getting chopped up trying to short a market, which is just not willing to drop, right? You can see here all the time yesterday in New York session where I was tweeting. Probably a bunch of you got stopped trying to short here. And then again, the same thing today. We had this bearish value gap, news came out and price went all the way back up to the range high. Again, pretty sure most of you tried to short this and got stopped break even, or got stopped for the full loss if you had your stop somewhere in that range here. Now the question is, how can we avoid getting chopped up trying to trade those conditions? And for that we have to reverse engineer the entire process of finding a trade, right? So if we think about the 4-step protocol, right? How to find a high probability trade. You have pretty much 4 foundations. We have the first one being trading conditions. That is the first filter which you want to apply before looking for a trade. Once we have favorable conditions, meaning we expect an expansion profile, we go to the next step, which is the higher time frame bias, meaning up or down. And then the third step is the narrative, meaning how is now price moving according to that bias. How is price going to deliver from where it's right now to where we expect price to trade. And then the last step, that is your entry model. And how can we now frame a trade according to our narrative and the underlying bias. Now the problem with most of you is that your trading is always starting around either narrative or the entry model. Meaning you open the chart and the first thing you do is you look at like the hourly, the M15, M5 time frame, and that's also the main reason why you guys get chopped up in such market profiles. So we start now with bias and trading conditions, and we go for that to DXY. Why? Because we always want to use DXY to frame our bias on. We want to align the DXY bias with a fitting major currency to then have a high probability framework to look for a trade. And for that, we go to the daily time frame of DXY, and we go all the way back to Monday. So that is Monday this week. And let's take a look here how we have been trading ahead of the weekly open. So this week we have the last week of the quarter, right? It's quite an important week, and we have to combine that with the fact that price already has seen last Wednesday and Thursday quite a large expansion above the buy side target of those daily highs, and we trade all the way up into the range high of this overall range. And we now have those equal highs here, but those ones are SMT highs, right? Meaning those are high resistance lows on pound and Euro USD. You can see here on Euro, we have here strong lows, so that's a high resistance low. And on pound, we already have taken out that respective high, which DXY has right here. So the question is, for DXY to go above those highs, we would need pound and Euro to also continue being bearish, meaning to expand beyond the sell side here on the weekly on pound, and on Euro to trade into those high resistance lows. So now on DXY, we obviously know we have here a bullish dealing range, but at the same time, we can't really be that sure if price will trade above those equal highs right here. The next thing we do is we take a look at the daily key levels, meaning which daily PD areas do we have here, the bullish ones and the bearish ones, which we then want to use to frame our trading based on. And we only want to use higher time frame key levels to then use those to frame our lower time frame intraday trades around those levels. We have this fair value gap here, which previously was resistance. We closed now above, and we also left behind a bullish value gap on the buy side. So we do have here a bullish BPR as our first daily key level. And if we take a look below, we also have a second bullish value gap and a daily bullish OP as well, which are those two down close candles. Now, before the week kicks off, we have to set our expectations. We say, okay, we are still in bullish order flow. We have bullish key levels, meaning we don't want to make the mistake of shorting into bullish key levels. Meaning, once we open up the week, we want to monitor how is price reacting to this first bullish PD array on the hourly time frame, and then we can get an idea if price wants to go higher from here or not. So we take a look at how Monday is closing with the Monday daily candle here, and on the H4 you can see here, once we opened up the week and price closed inside this daily bullish key level with displacement leaving behind a bearish value gap, that right here told you that price wants to seek this internal week low down here, which is the lower daily value gap and the second bullish key level. So we know now, okay, we want to see price approaching that key level, and then we want to look for a reaction below this low and also the daily bullish OB. But that's not the only information we got. We also now have seen price closing back below this daily bullish key level. So if price is truly bullish, we would not see price closing below that one. Instead, price would use that bullish key level and expand higher from here. So price telling us that it's closing below gives us information that we're not as bullish anymore on the XY as we would expect if price truly wants to seek those highs early on in the week. So now what do we have here? We have trapped order flow. Why? Because price is right above a bullish key level and below a reclaimed bearish one, meaning price can now consolidate between those two opposing PD arrays. All right. Do we want to short into that bullish key level? No, we don't. We obviously can look for shorts on the lower time frames within that range, right? From range high to that level here. At the same time, we also don't want to go to the lower time frames such as the M15 or the M5 and look for longs down here. Why? Because the hourly time frame and the H4 are obviously still heavily bearish at this point. Meaning we want to wait for price to approach this key level and then look on the H4 and H1 how is price responding to this key level. That's exactly what we're going to do. And you don't want to go on the lower time frames as long as you don't have a clear picture on the hourly or H4, meaning seeing displacement from this lower bullish key level. We have Tuesday here, and now price taps this lower bullish key level. So now what do you want to see? I mentioned we want to see on the H4 or the H1 bullish displacement to confirm that price wants to trade higher from this key level and then ideally reclaim this daily one and then expand higher. But as long as price is just consolidating between those two levels, we don't have a high probability framework to look for an expansion, right? Because remember, price is trapped between two higher time frame opposing daily key levels. Now again, we have new H4 candles to work with, and what do we have here as well? We left behind this H4 imbalance right before we tapped into the lower daily bullish key level, meaning we have swept the internal week low of that overall range low, range high. And what price will most likely do now, it will go back to some internal liquidity of this range, right? We have this H4 strong high, we left behind this H4 imbalance, so that is now internal liquidity. So if price now the lower time frames is retracing into this H4 key level, you don't want to do the same mistake and long into that key level because price is still obviously bearish and we could trade up here and then still go lower. So if you long up here, long right here, have your stop somewhere down here or here, and then price comes right back on you and stops you out, meaning that's low probability, right? You don't want to look for longs until we can reclaim this H4 imbalance, and then we can look for longs from here into that high, and then if the daily also closes above, we can look for more longs from here, right? So let's take a look at what price is doing. We retrace, we engineer week high, we sweep that weak high into the key level, and that's the exact framework I mean. That's where many people then get into longs, because if you take a look on the lower time frames, you see, okay, M15, we have here, bullish order flow in the M15. But again, we want to take a look at the H1 and the H4 closures. We don't want to take a look at what the lower time frame is doing, because as you can see, we have the daily key level right here. And we also have this H4 value gap, which price has not yet closed above on the H4 time frame, meaning you don't want to look for longs here on the M15 as long as the higher time frames are still respecting those key levels. So we take a look here at what price is doing. You can see here price chops around and again trades at a bullish key level and goes higher again. And that's exactly what I mean with trapped order flow. Price is not willing to get above, but also not willing to displace deeper into the range lows here, because price is still respecting both the bullish key level and the bearish key level. Meaning at this point, you have no business in going to the M15, M5 time frame and look for trades into those highs or even beyond. And that's also one great example where you can just, check the charts every few hours and see if something has changed. And you don't want to waste your time watching the M5, the M15, because you will just end up taking bad trades and forcing trades inside this range, trying to call a bottom on the XY. And that's just low probability, meaning you want to wait here before we have a higher probability framework for longs on the XY. You want to see for price to close above, and then once you confirm a reversal here, we form the low risk buy, and then we have here a high probability framework to look for longs. But as long as that's not given, we are still bearish and you don't want to look for longs. What is price now doing? We have equal lows down here, respecting the bearish key level. So most likely price will reach again into those lows. And then we have a double sweep. And then again, we see how is price now reacting to the OB we have still below. And also, if you can see then some displacement to the upside. Price comes lower, rejects the highs. Then again, you don't want to now say, okay, I will long here on the M15. Because yes, on the M15 we just place higher, but again, we have swept the sell side, tapped the bullish OB. So obviously we can expect some bullishness on the lower time frames because we just hit a daily bullish key level. But that lower time frame bullishness doesn't mean we will now go straight away, up in one line. Because again, we have the H4 imbalance above and this daily key level right above. We watch again, can price now on the H4 get above here, and then we have a long framework. We have confirmation, inversion level, and then we can look for longs into that upper daily key level with those equal highs, right? That will be then a high probability framework to look for an expansion. Again, what do we have? We have price sweeping a week low into the same key level, and we just place lower. And then we see price continuing to dig into that daily bullish imbalance and the daily bullish OB. So what do we have now here? We have a bearish value gap forming on this way down. We have a new hourly bearish key level. So now if price is returning into this key level, do we want to look for longs? No, we don't. We want to see price to at least close above, and then we can look for longs. But if price is approaching that key level, you don't want to look for longs here on DXY into that key level. It's the same as here, right? And that's what most of you guys just keep doing because you want to force your bias and narrative onto the market instead of just waiting for price to give you confirmation with the proper time frame alignment, meaning daily key level. We need therefore an H1 or H4 confirmation, and then we have a high probability framework to look for trades. But as long as that's not given, price is still bearish on the hourly, we have bearish order flow, and you don't want to try to long into those key levels. Now, in some weeks, this works out, when the lower time frames are bullish, and then the hourly key levels, bearish ones or bullish ones, get inverted. But in such weeks where, price just remains bearish and the lower time frame change in order flow doesn't lead to higher time frame inversion level, and you will just get stopped out, back to back, then you start tilting, revenge trading, and suddenly you then end up blowing your entire account in like one day or 1 week. Price comes back up, right? Again, we push it up higher. Can we close above? No, we can't. Again, we have this bearish H4 above us. So you don't, again, want to long here. Again, price goes lower. You're still respecting those daily bearish key levels. And that is just one example where you just watch price in the hourly, you don't get your confirmation, and you don't force any trades on the lower time frames, because you can see every time you try to long a lower time frame confirmation, you would gotten stopped out straight away once price rejects the H4 and hourly bearish key levels. Same thing here. We have lower time frames, bullish value gap, then you long this here, price comes back higher, sweeps those highs, and immediately stops you out. And now also, if you take a look at Euro, you obviously do the same thing here. We have on the daily time frame, bearish value gap, daily bearish OB, and we also have this inversion daily bearish value gap. Now, what do we have on the bullish side? We have on the daily this bearish one, which we closed above on Tuesday. But if you go to the H4, we have this value gap here, which we used to look for longs once we closed above here on Monday into those range highs. And then the same thing here. What is price now in? We have this bullish inversion value gap. We have the daily bearish clouds above, and price keeps respecting both. So as long as price consolidating between those two opposing PD areas, that's exactly also what I told my members in the Discord daily outlook streams. As long as we are chopping around between those two opposing PD areas, I'm not going to look for any trades within that range. You can look for scalps at the range highs, right? Meaning range high, range low. So you can look for shorts to the lows and longs to the highs, but you don't want to short down here into the lows or long up here into the highs, because you are shorting into a bullish key level at the lows and longing into bearish key levels at the range highs. And also one more thing which I see many people always saying, yeah, but we had SMT at that high or SMT at that low. The thing is, if you're on a consolidation profile, you will always find SMT at the range lows, because price in neutral order flow, and that's where you will always find Kraken correlations at the range extremes, meaning at the range highs and range lows, because price is a seek and destroy profile. And again, I told you earlier in the video, the correct order is trading conditions, bias, and then narrative. And SMT is part of narrative, meaning if you don't have a bias, you don't want to look for SMTs to confirm your idea. Because if the bias is not clear, since we are trapped between opposing PD areas, there's also no point in looking for a narrative, because you don't even know where price wants to head on the higher time frames. So that concludes today's video. If you learned something, then leave a like and a comment down below, and I will talk to you guys again next week.